Hello everybody, my name is Zach Hartley, and in this video I'm going to give you 5 tax tips and strategies to help you save some money on your taxes going into the year ahead. Here is everything you need to know. Let's go. Okay, so number 1 here is to take advantage of your registered accounts. These are accounts that the government gives you that have built-in tax breaks, so you might as well take advantage of them. The 2 main accounts that you want to consider first are the tax-free savings account and the RRSP. You've probably heard of these accounts before, but let me just give you a quick run through of how they work. When you put money into your tax-free savings account, it is basically a specific type of account that you open up at your bank or Wealthsimple or Flamingo or any trading app that you want. And what's nice about it is that any gains that you make in that account or any profits that you generate are completely tax-free. You can also withdraw your money from that account at any time up to any amount, and it's really nice because it can also sometimes act as an emergency fund for you. The only place that you will get taxed when holding money within your tax-free savings account is if you receive dividends from a foreign company such as the United States. You'll pay about a 15% tax on that dividend. You will not pay any taxes on the sale of the asset though. So something to keep in mind here, the tax-free savings account is really nice because you can invest your money and you don't get taxed on the profits. The only problem with the TFSA is that it does have a contribution limit each year, usually around $6,000, $7,000 depending on the year that you're in. Now when it comes to the RRSP, it's sort of a similar account. You open it at a bank or you open it with a brokerage, but it is tax deferred. So instead of tax free, this one is tax deferred. And what that means is that the money that you make this year, you would have to pay taxes on. But if you put it into an RRSP account, you can delay paying taxes on that money until you pull it out of that account, usually in retirement. So you don't pay taxes on it now, you pay taxes on it later, and you can use that money and invest it now and grow that money so that by the time you hit retirement, it's a much larger amount, and you're also probably spending much less in your lifestyle because your house is paid off, your car is paid off, and you're just eating and living and doing some traveling. And so you usually need a smaller income, which means you also pay lower income tax on the money that you do withdraw. So it's kind of like, don't pay tax now, pay it in retirement, and hopefully pay less tax in retirement. That's the advantage of the RRSP. The real advantage of it right now, though, is that it will reduce your income tax. So if you're in a high tax bracket and you contribute, let's say $20,000 to your RRSP, it will reduce your taxable income by $20,000. So if you're paying 40% income tax and you put $20,000 in and you get that tax break, you're getting $8,000 in taxes back from the government, which is really nice. And the RRSP, because of that factor, it gets better for high income earners. So if you're in a very high tax bracket, the RRSP looks more and more appealing. Now, when it comes to taking advantage of these accounts, one thing that you need to understand is with the TFSA withdrawals. If you withdraw money from your tax-free savings account, but it was maxed out before that, you cannot put that money back in the same calendar year. You have to wait till January 1st, and you get whatever space that you withdrew, you get that back in the new year plus your new contribution limit. So that means that if you withdraw your money in December, so let's say that you're gonna need money for whatever reason in the new year, if you can withdraw it from your TFSA in December, you basically take that money out of your TFSA, and then whatever space that you took out there, you get that back coming January 1st. Instead of waiting until January, February, or March, whenever you actually need that money, if you take it out during that time period, you're not going to get that space back till the next year. So if you're planning to withdraw money early in 2023, consider withdrawing it from your TFSA in December of this year so that you get that space back going into next year, which is really nice. Next thing here is that you can withdraw from your TFSA and put it into an RRSP to reduce your income tax. So let's say that you made profit in your tax-free savings account. You can withdraw that profit completely tax-free, and then you can put it into your RRSP, and it acts as a contribution to reduce your taxable income, giving you another tax break, meaning that you are then using your tax-free profits to reduce your income tax, which is just a really nice kind of setup for most Canadians. Now, it does get better if you are in a high income and you have excess cash, but that is just something that's dependent on your personal situation. I'm just walking you through why these accounts are so nice. Now, going on to strategy 2 here, tax loss harvesting. This is the idea that you're going to sell your losing positions to realize a loss and reduce your capital gains tax. So if you have a capital loss, meaning that you sold positions at a loss, that can offset your capital gains that you have to pay tax on. It can reduce those capital gains and it can bring your overall tax bill down. Now, there are a couple of caveats here. Number one, this only applies to non-registered accounts, so do not try and do this in a TFSA or an RRSP account, which are the two that I just explained to you. Also, you cannot buy the same positions back within 30 days, and that rule also applies to your spouse. So for instance, if you have a losing position in, let's just say Amazon right now, you can sell Amazon, you can realize that loss, you can write off some of your taxes, but if you like Amazon long term, you cannot buy back into it for at least 30 days in order to take advantage of that loss. Otherwise, if you do that, it is deemed a superficial loss and you will not get the actual tax write-off. So this is super important. If you want to learn more about this, I do have a couple videos on my channel. But moving on to strategy 3 here is delay taking profits. This one is really interesting because let's say you have a couple of profitable positions right now where you're considering taking some off the table. I would caution you to do it in December. The reason for that is because if you delay selling your profitable positions until January 1st of the new year, your capital gains tax is not due for 14 months. Remember, your personal income taxes are usually due in April, which means 4 months after basically the year ends. And so if you sell those positions on January 1st of the new year, you have the rest of that year plus January, February, March, April you actually have 16 months, bad math here. You have 16 months here in order to basically invest that money and try and make more money on it to pay that tax bill. However, if you sell those positions in December right now and you have capital gains tax that is going to be owed on that position, you're going to owe that money in a maximum of 4 months in April of the new year. So if you have profitable positions, I would caution you against taking profits in them right away. If you can wait till January, it will give you that extra basically buffer here before you have to pay the tax bill. Now, number 4 here is donations. This one actually blew my mind when I was doing research on this video. It's really cool because if you make donations to a registered, this is super important here, it has to be a registered Canadian charity, and I assume it's probably similar in the US, you will get a tax credit to reduce your income tax. Now, that tax credit is based on a federal tax credit and a provincial tax credit. So it depends on what province you live in here. But I personally live in Alberta, and if you donate enough money and you just kind of get over their threshold, you can get over 50% of your donation back as a tax credit, which is absolutely amazing. So imagine that you write a $20,000 check to a charity, you get $10,000 of that back as a tax credit to directly lower your personal income tax, which is really nice in my opinion. Number 2 here is that stocks can also be donated so you don't have to pay capital gains tax. That is really cool because let's say you have a position that has just gone up astronomically and you're about to pay capital gains tax on that. If you donate that, you, number 1, don't have to pay capital gains tax. Number 2, the registered charity can accept them, which means they are getting a larger total amount of dollar net value in your donation here, and you are still getting all of the benefits of the donation. So you save the capital gains tax, you get more money to the charity, and you get all the benefits of making a donation. And in Alberta, it is up to like 50 or 51%. It's really crazy here. So here's how it breaks down. Any amount over $200 here from the federal government will give you 29%, and in Alberta it will give you 21% here, which is exactly 50%. So really quite amazing what you can get just for donating, and donations can also be pooled among spouses. So if you and your spouse are donating, you can pool that together to get a bigger tax credit back, which is really nice. Now, number 5 here, this one's probably kind of simple and you've probably thought of this already, but you just need to understand what you can actually deduct from your taxes because most people forget things. So moving expenses, you can get money back. Consulting fees, and especially financial advice, you can get money back from the government if you spent money on these 2 things at any point throughout the year. Home office expenses, you can get money back. Self-education expenses, RRSP contributions. This is another form of registered account that you set up in your child's name for their education. Very, very similar to the RRSP, but it's for your children. Definitely look at that. That's another kind of tax deferred system, which is really, really nice. Student loan interest. If you're paying any student loan interest, you can get some money back for that. And if you have any medical expenses, you can get some tax deductions for that as well. So there's a big list of this. If you want to look into it more, you can just Google it. But if you get any value out of this video, remember to click that like and subscribe button. And if you want to learn more about personal finance, about day trading, about investing, about credit scores, about any of that, I put all of my courses on Skillshare. They're completely free. You can find all of them on there, and the link is in the description down below. When you sign up for Skillshare, you get 1 month completely free, and it's basically like Netflix, but for courses. So you can scroll through, see whatever you want to see, take whatever course you want to take, and it's basically a monthly subscription, but you get 1 month free to try it out. Link in the description down below. Thank you so much for checking out this video. I sincerely appreciate it, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.